Good afternoon and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm happy to be here.
I'm glad you're here. Well, this broadcast is being recorded for future use. So this week in the news, we just learned that Kamala Harris has been selected as Biden's vice presidential candidate. Now, that's certainly an historic moment for African American women, Asian American women, and Indian American women. But there's more silliness starting, probably not starting, it's already been going on, but it seems to be escalating, namely the negative campaigning towards opposing candidates. Now, while Russia claims to have a vaccine, the U.S. has agreed to pay billions of dollars to companies like Moderna, Johnson & Johnson, to produce and stockpile vaccines that are in development in hopes that when one or more are approved, they're ready for distribution. More NCAA sports in the fall have been canceled, and that sure puts a damper on TV entertainment for at least for the next fall, for the next few months. Sporting the Cardinals, even though they haven't been able to play a game. But the markets continue to climb the wall of worry, which you often reference.
Yes.
So can you help us understand what's happening out
there?
Well,
I can give it a shot.
You always do such a great job. Let's see how you do it today.
Let's do a quick recap as we continue to move through our coronavirus timeline. And we are seeing that economic activity climb out of that deep hole that we were in earlier this year, as well as industrial activity rebounding. And we just recently saw the PPI numbers come in, and they were by no means extremely high, but they were positive, which means that there's competition for producer prices, so that's showing a little bit of sign that the industrial activity continues to rebound and really get out of that deep hole as well, John. Coronavirus has continued to dominate the headlines, but we are seeing a reduction in the new cases. We had said a few weeks ago that we had anticipated that we were peaking, really based on the way that the growth of the new cases were realizing that growth was really starting to slow. And so far that's proved to be true. And we also continue to look at that lag time of the new daily deaths. And did last week to say we probably got 1 or 2 more weeks of elevated cases or elevated deaths before we start to see a decline there. Today's numbers were a record high, but it really was only a few people. Every death is tragic, but it was only a few deaths higher than it was a couple of weeks ago. So once again, we're not seeing the growth that we had saw before. I would expect to see some elevated numbers for a few more weeks. If you remember, as we were going in there, we were talking about how the new cases had continued to increase for about 4 or 5 weeks before we ever saw really a noticeable increase in daily deaths. So maybe that 2-week lag time that everyone has been working off of, maybe it's a little bit longer than that. And if that's the case, we would expect to see some elevated deaths for a little bit longer. But my guess is we're near that top of that peak. In the next few weeks, we'll start to notice that decline, like we have clearly noticed a decline in those.
Well, the interesting thing is the regional differences, as you're going to talk about.
Right. So the states that are increasing, well, first off, there's hardly any states here, and some of them are actually just U.S. Territories. Notable, though, is Illinois and Massachusetts. We're definitely going to watch those areas. Both of those have had their initial spikes, so maybe these are true second waves, so we want to pay attention there. But as we're seeing that drop in new cases decline, we're seeing a lot less states that are showing up in that increasing category. More of them in most of the same, to be expected. We're kind of rolling over, so some of these states are going to drop off, and they're all going to end up in that decreasing carrot. So slides are a little bit delayed here, so I'll let them catch up. But if you look at Louisiana, that's a true second wave. And remember the Mardi Gras, we talked about that, where you had an initial spike and then a late comer as the Sun Belt cases arrived. And if you go into Delaware, it's not a second peak that's higher than the first peak. But we want to watch that. And what else is interesting, and we're trying to understand, and we don't really see a clear pattern for any state, is why some states had a slow, gradual climb that continued on through the lockdowns, some of which had a peak that didn't really change much, but then you also have others, let's say like Mississippi, that has an exponential growth rate for the peak and then drop. Florida is another example of that exponential growth and then drop.
And is there any relationship between, let's say, lockdown and the case count?
There does not appear to be any correlation between lockdown and case count. There doesn't seem to be any correlation between mandating masks and this is one of those viruses that you'll have a good story, a good narrative, try to explain something, but then there's always this counter argument that derails that thesis. So this is just one of those viruses that we really haven't been able to find what the commonality is. I know it's there. We all know that there's something there that's causing this. I don't think anyone's really actually figured out what that is at this point. But the good news is we are seeing it decreasing, and it's just basic math. The more people that have had the virus, the less that there is for a susceptible pool to later get it. So having these waves, first and second wave, it should be, unless a virus was to mutate, that we would see a continual decrease in the outbreaks, a continual decrease in the deaths relative to those cases, as well as we hope. It's rare that a virus mutates and becomes more aggressive or more deadly. They usually go the other way. That's been the case here, as well as medical innovation, as vaccines. Whether Russia has an actual vaccine or not, there's a lot out there that is in the works.
So what do you think this will do in terms of governmental actions going forward if we see this continuing trend? Because that's one of the things that's really impacting the economic recovery, is this continual shutdown.
Yes, I think Sweden has given us a model to look at and question whether that's an actually effective use. A lot of the things when you're trying to study. So hopefully we're able to take this information, study, find out what did and didn't work. There is concerns that we've set precedents, and there will be reactions by the government that could try to slow down or use these tactics to try to slow down future pandemics. We really need to have a good cost benefit analysis. The head of the CDC last week was mentioning that there may have been more deaths caused by the economic shutdown, people losing their jobs, getting in depression, having higher rates of suicide, people not going to the hospital, getting their cancer screenings or heart attacks than were actually prevented from the slowdown. So there's just a lot of moving parts. It's very complex, and whether this precedent is set as how we're going to deal with it going forward is still yet to be determined. And really, it's really difficult to make these decisions whenever you're trying to compare so many different outcomes and so many different opportunity costs that you have to deal with when making those decisions. So if we were to decide that this is the new normal, this is how we're going to deal with them, the economy is definitely going to have to arrange itself to deal with disruptions if we're going to continue to have growth. Yes. And remember, we've talked about it before in several calls that especially in the developing countries, this has impacted them. We've had a lot of people drop into severe poverty again. We've actually had, for decades, we've been pulling people out of poverty. And some have gone back in because of that economic slowdown, which has also cost lives outside of the U.S. So there's a lot to really understand and through this. The headlines, though, with the drop in the coronavirus, and then, as you were saying, we're entering silly season, and very silly. It's getting very silly, and negative ads. I think they've been ever since there's been advertisement. There's been negative ads, right? So, so the 2020 election's probably going to start to dominate the headlines more so than the coronavirus, and they'll probably become dominant. I know people have been asking us about what do we think about the election. And now we're about 90 days out, still in an eternity whenever we're talking about an election cycle, but it'll probably become more prominent not only in the media, but also in our market update because we are starting to get into crunch time and where it makes sense to sharpen pencils and try to figure out, what is the outcome of the election and how's that going to impact the market. Now, one thing that people are looking at are polls, approval ratings. They'll even look at the the betting markets where you have predicted, where they're trying to determine who will be the next president. And most of those would say it's not President Trump, that we have President Biden. We think it's way too early to make a call on that. And if we learned anything in 2016 and Brexit, it's that these things can be very wrong. So trying to really get a good picture of this based on this outcome probably isn't a good strategy. So as an example, Donald Trump has had low approval ratings pretty much the whole time, right? He's been actually never.
Poor guy, he's never gotten above 50%.
He's never been above 50%. The first day he's elected, he's actually at 37%. Today, I'll get the numbers a little bit later, 39%. So I guess he's actually been trending up through this time.
That's a long-term trend.
And 39% where he is today seems low. And if we look back at President Obama's approval ratings, and this slide shows 8 years, we can see that he had a nice honeymoon period at the beginning with a very strong approval rating, 67%. But remember, that was 2008, 2009 timeframe. When he became president, we were finally in a recovery after a very deep depression, recession type of sell-off. The Great Recession is what they had called it. But as he got further along in his term, his approval ratings dropped. So what we want to do is we want to compare the first term of President Obama to the first term of President Trump, at least up till June, where we have the data, and see how they compare. Letting the slides catch up. So here we go. So we can see that honeymoon period, Barack Obama has a downward trend all the way to the mid year of his last year on his election cycle. We all know that he does win his second term. And it's likely as he started to campaign, his approval started to move up for the victory on his second term. President Trump has not had the honeymoon period, but he's really right around the same approval rating as Obama if we look at the same time period halfway through. So Trump right now is at that 39% approval rating. So yet to be seen. Now, it's not to say approval ratings don't matter at all. Usually those that are starting out with low ratings, whether that's H.W. Bush or Jimmy Carter, do not win the second term. But there are plenty of other examples, Barack Obama being one of them, where they do win the second term. So once again, still too early to tell. Ultimately, we think that really focusing on those polls is really not where you should spend your time. Why? Because polls don't elect presidents, betting markets don't elect presidents, even national or popular vote do not elect president. If you remember, Hillary Clinton won the popular vote, but lost the electoral college vote. And we elect presidents through the electoral college vote. This is right now where the consensus is on the electoral college makeup. There's still a lot to be determined. Biden does have a slight advantage on the count at the moment. And this is what it looked like in 2016, a very surprising result where Trump was able to take Wisconsin, Michigan, and Pennsylvania, as well as Florida. And we think these are really the key battleground states. So if we were to take those two out to try to look at these, slides are going slow, sorry guys, and try to focus on where our attention should be, we believe it is those 4 states. And specifically, we want to pay attention to Florida. To those that can remember the evening of the last 2016 election, Hillary Clinton was a strong favorite, whether that was in predictive models, those betting models, or statistical models. She was pretty much considered a shoo-in. It was done, it was over. But things churned, and that churned whenever Trump was able to win victory in Florida. So we think Florida is a key state to pay attention to. And in this slide, we're looking at, well, what if Biden wins Florida? What is it that Trump needs to get to still win the victory? Well, he would need to win Pennsylvania, Michigan, and Wisconsin again to be able to eke out a electoral college map. And we think these are the 4 key states to watch. Other ones are probably going to more likely resemble what happened on the last election. So if he doesn't win Florida, he's unlikely to win all 3 of the states. He's probably not going to win. I mean, those are if Florida goes for Biden, I don't think any of those other states are likely to go for Trump. Maybe one by chance. But we're going to focus there. And if we start to look at the polls in Florida, we showing up, there we go. We can start to see that there really are 3 columns right now. And Biden is currently in the lead. And this has been the case really since he was nominated and the coronavirus pandemic showed up. So Trump has kind of lost that. He was a little bit ahead. But there are 3 columns. There's Biden, there's Trump, and then there's that other category. And if we look at that other category, there's 11% in the most recent poll. I promise you, the Green Party and the Libertarian Party is not going to take 11% of that vote. And
they would consider that a victory.
That would be a huge victory for either one of those parties if they just they split it. It's probably 2-3% that those 2 parties cumulative will actually get out of the election. Well, that means there's still 9% up for grabs, and the polls are very aware, especially since 2016, that when they're asking people who they're going to vote for, there is a tendency to not admit that you would vote for President Trump. That happened last season. So they've been asking 2 questions, and really these are 2 questions that they've been asking since polls have been done: is who are you going to vote for, and who do you think is going to win? And as a predictive basis, now remember it's wrong at times too, but as a predictive basis, the second question is actually done a better job of predicting the ultimate winner. Is who do you feel is going to win versus who are you going to vote for? And this may be a more informative question this time around, being that there is this phenomena where people will not, or possibly would not, admit that they're going to vote for Trump. So let's say that he gets all but the 2 or 3% in this poll that is goes towards Trump. Well, that means that we're at a dead heat in Florida. There's really no difference between the 2, and it's a lot tighter of an election than what we predict. And we think that's probably an accurate description of where we are in the election cycle. Once again, we're 90 days out.
Right.
Enormous stuff is going to happen, right? Take this as a grain of salt, and don't go out there and make bets on the market unless you want to take the underdog side just because of the risk reward. Doesn't mean you're going to win, but that's probably your better payoff if it does. So then it's not just the presidential election. People are asking about the Senate and whether the Senate, which is currently majority Republican, will remain Republican, or will the Democrats be able to take the Senate? And the way that the Senate election is structured, you have basically 1/3 of the seats up for grabs because it's 6-year terms, and every 2 years, 1/3 of them are up for re-election. And if you look over here on the right-hand side, you can see those contested seats that are up for grabs this time. One, there are more red dots than there are blue dots. So there are more Republican seats that are contested than there are Democrats. That obviously favors Democrats versus Republicans at the moment. There are a couple of seats. The Alabama seat could, at least based on polling, go from Democrat to Republican. And then there is one seat in Arizona that could go from Republican to Democrat. Let's call those neutral, that they both flip or they both stay where they are. There's no change. And then we start to look on there. Most of the seats are going to go, are favored. If it's a Republican seat, it's more likely to stay Republican. If it's a Democrat seat, it's more likely to stay. But there are a few toss-ups, mainly Republicans. Let's say it's a 50% chance. What we think is the most likely outcome based on today and just based on probability is that Republicans will lose some seats, but likely have enough to maintain a slight majority in the Senate. So that's our current call. Obviously, as we get further along and really to see what kind of enthusiasm is going to be there for the Biden ticket, whether there's some type of sweep can change that. But just based on probability, we think the Republicans are likely to lose a few seats. Next question is the House. I would say that the Democrats are likely to have the House, but unlike the Senate, where we only have 33 seats that are up, that's a manageable. Most of them are going to be refilled. every seat in the House is up for election. That's 435. There's no way for us to be able to tell and understand. No, there's just too much to understand within the different districts. Once again, we think the Democrats will hold it, but there is a phenomena that we think will really play itself out. And we saw it in these primaries is Lacey Clay, who between him and his father held a seat for over 50 years. He was very progressive relative to many other people in the House. Lost his seat to an up-and-coming Cori Bush. She began her political career during the Ferguson riots, and she was a Black Lives Matter organizer. And she was running great ads, and she was able to unseat a 50-year, essentially, incumbent. And she is more to the left. So the more progressive seats are becoming even more progressive. Now, this phenomena is not just showing up on the Democrat side. It's all these new factions, and the Republicans have plenty of new factions. And if we look at Colorado Congressman Scott Tipton, another established Republican, he lost his seat in the primary to Lauren Boebert. Probably mispronounced her name. I've yet to see anyone pronounce it, so I'm just going off spelling. Sorry, Lauren, if I mispronounced your name. She is an owner of a restaurant called Shooter's Grill and Rifle. I think we have a pretty good idea where she falls on the political spectrum, and it's probably to the right of Tipton, who was already on the right. So what we think is going to happen is there's going to be more polarization between the House seats. So if you think the rhetoric is bad this year in 2020, we think that's going to continue. Is this part of that phenomena where we just have social media where most of us will start to get into echo chambers because of the things that we like and we follow, and we don't hear and don't communicate with others as often that have different views? I think that's a pretty good explanation on what's going on in the world, and it's starting to show up in our political parties as well. So Democrats probably hold the House. Polarization continues to increase going forward would be our prediction for the elections. So now we're moving into economic data and GDP. Last week, we did have a decline relative to the previous week, mainly because of employment numbers. I want to get into those employment numbers. So let's go ahead and take a quick look at those. So number of employed increased by 1.8 million jobs in July. Now that is lower than the previous 2 months, but it's still a gain. So that's this top left corner.
So that's good news.
And that is good news. And that also means that the unemployment rate dropped. So it's 10.2%. So far it continues its decline. Let's hope it continues that decline. Unexpectedly, so this was kind of a shock, is new job openings. So people looking to hire people actually increased by about 500,000 jobs from the previous revised number in May. New hires, I know it seems like I'm saying the same thing, but these are a little bit different on each one. So the new hires did edge down. So new job openings were up, but new hires were actually a little bit lower than they were the previous. Now, what this doesn't include is those that are getting rehired. So they were furloughed during the lockdown, and then their company is back. They're bringing people back on. Those are not getting caught in these numbers. Nonetheless, we still think there's probably a drop here, that this is a real drop and one that you want to take note of. And we think it's likely to do to the slowing down or actually reversing some of these reopenings. So there's been a pullback in some of the new hires. But ultimately, we think as much of an issue as we do have, and we do see some rough economic numbers, under the surface, the economy is slowly recovering. This has been the fastest bear market correction in history. And we think that there's reasons for that. And it's not just the Fed. We think that has a lot to do with how the monetary expansion, but the real economy underneath is slowly recovering as well as adapting. We are far better at doing things like being able to order out, make different changes, wear masks to go to places. So we seem as a society to also adapt to these current situations. Now, this picture of Trump, I think whether you like him or dislike him, this probably captures.
He likes himself in that
yes,
picture.
It's kind of his smuggishness. This is a picture of him signing some executive orders. And he did sign some here recently. And the reason he did is because we had that stimulus bill. We said 1 million, maybe 3.5 trillion. It wouldn't be under 1 trillion. I'm sorry, 1 trillion, right? At some point, we're talking about real numbers. Well, it turned out that August 7th recess came and that bill was not passed. So the president decided to use executive order and bypass the legislative process to put this in place. The $400 unemployment benefits were passed as an executive order. Really, it's $300 by the federal government, and the state is supposed to pick up the extra 100. There's provisions the state can ask the federal government to pick up that tab, as well as a payroll tax holiday. So you'll see some of those Social Security taxes drop off as a part of a stimulus package, as well as student loan relief and the eviction moratorium. So people that were getting kicked out of their homes have some relief there as well. So another thing, though, that we are seeing as a possible executive order is lowering the capital gains tax. And what they would do is they would increase your cost basis with inflation. So if you bought a $100,000 investment, there was 3% inflation, your cost basis would be moved up to $103,000.
Well, I think the accounting field would love that, because that would create a lot of work to track.
A lot of billable hours, and whenever we decided back in the 80s, and we had a very robust discussion in Congress on what the tax code should look like, and we got into tax code theory and philosophy, they had decided that the reason that a capital gain tax was lower than an income tax is because there was some return of your base capital because of inflation, but it would be way too complex and expensive to try to track those, so that's why you got the reduced rate. So we at Gatewood Wealth Solutions think that these should not be done by executive order. Every party does it whenever they get in, and it seems like each president actually increases the use of them and uses them at a way that is bypassing the legislative process more so. So we would actually much rather have that large, robust discussion on the Senate and House floor on what taxes should look like versus just the president going by and deciding that they're going to do this on their own. So that's our opinion on it. And the other thing is these are still going to be increases in spending by the government, which is probably going to be monetized by the Fed as well.
Do you think that the market is priced in the financial impact that is going to have?
I think it's still a little early on the capital gains component, but if that was to go, we would want to see, is it actually going to stand up? And if we think it is, then we're definitely going to be looking at clients' portfolios to see if it makes sense to realize some of those capital gains if they're getting a tax cut based on their basis. Like you said, it is going to be very complex and complicated. A lot of billable hours. Maybe the accountants want this to go through. But this was not something that the current administration came up with. It's actually something that had been sitting on the table since I think H.W. Bush originally had thought about this, but they didn't think it would live up to or be able to stand up against the challenges. So let's see what happens. I don't think the market is giving it a high probability at the moment, so it's probably not getting priced in by much.
So let's move into your teaching moment.
Yeah, so let's each week we've been reviewing some of the fundamental building blocks and the way that we look at the market to help really bring some clarity on why our investment themes are what they are. And so far we've covered marginal utility theory, where things get value, and the idea that the more you have of something, the lower the price, and ultimately you're going to determine your demand by what you can use for that last unit. So if you had 1 unit of water, the price of water is going to be very expensive. If you have 7 units of water, that 7th unit is going to be a low price, but all the units would then have the same price. So it's at the margin that the price for the whole economic good is set. So that's how you get over, like, water has much greater use for us than a diamond. Why does it have a lower price? Well, because we have a lot more of it, so we can easily meet the demand of drinking it and then also have it in our yard. So we're going to pay for it at the price that it costs to put it in our yard, not necessarily drink it. We've also discussed regression theorem, which was the idea that money, really good money, had those 4 characteristics, and those characteristics would show up in a barter economy, and people would begin to favor some commodities that better represented those, so that how money could just out of market phenomena arise as a medium of exchange. And then once that money was there, how banking could arrive, and they would start to use certificates, paper money accounts as proxies for money, and be able to either expand or contract the money supply. And we talked about if it was still tied to a commodity money, how you would always get a bank run. And then ultimately we had to decouple from the commodity money. When we did that, it was gold at the time, to prevent those bank runs. But we left it with a question on whether there was still a fundamental economic issue by expanding and contracting the money supply. And to answer that, we went into stages of production last week, as well as production possibility frontier, which we're going to review those really quickly. But we're also going to look at the loanable funds market. So let's jump into that, John.
Great.
So remember, we were talking about the fisherman turned boat builder. We were pulling this from a previous story many market updates ago. And we looked at the stages of production for the fisherman. The early stages, and this is capital formation, capital tools, we talked about him needing to have a spear. And in the middle stages, where we start to mix our labor with those capital tools to produce economic goods. So fishing for our fisherman, and we assumed that he could get 5 fish a day. So that was his production by mixing labor and capital tools. And the whole point was not to fish, not to create a spear, but to have fish to eat. So if you wanted to understand the value of a spear, it was ultimately based on the fact that it could provide fish, which had the end that you wanted to actually achieve, which is a full belly. We continued on and looked at the 5 fish and said, okay, well, this means we have a production possibility frontier. We're generating 5 fish in production a day, and we can either consume them or we could invest them. Now, if you invest all 5, it's going to be quite the diet that you could be on, and that's probably another good. That
I'm trying to eat fewer than 5 fish.
You have to have a really developed economy to make that a product, though, I think. So in our example, the fisherman would set aside out of his daily production of 5, 1 fish. So there would be excess resources or savings set aside. And the point was, in our story, is that every 5th day, his spear wore out and he needed to have 4 additional fish for consumption. So he made a new spear. So he had to save excess resources to make that capital product to mix his labor with. So his economy was based on his consumption of 4 fish and saving 1. So we can see his late stage, or the point of that was to consume 4 fish. That was his standard of living. And then we assumed that he had the idea of a boat, and he started to reduce his consumption. So his late stage part of the economy actually dropped to 3 fish a day as he set extra resources aside for savings that would later be used for investment to put that boat plan into action. And along with that fish or the spear, they would be able to increase the amount of daily production from 5 to 7 fish. So he continued to save 2 out of that, meaning that there were 5 fish left to consume. Well, that was a 25% increase in his standard of living before the initial change, when he was only consuming 4 fish a day. So that was a way of growing his economy by setting resources aside for capital improvement to ultimately able to produce more economic goods. Let's get our slides to move here. So the idea is that he needs to set 2 fish aside, right? And he could reduce his consumption, but really what you need is 2 fish. What if there is another person that you could borrow from? Let's say another fisherman who is producing excess fish, and he can set savings aside, which is 2 fish, and maybe he could loan those fish to our boat builder. So letting this catch up, we now have a loanable funds market. Now, why would the fisherman loan 2 fish to the boat builder? Well, we know that a bird in the hand is worth 2 in the bush, right? Our parents all taught us that's important, that things today are worth more than things tomorrow, or if they're uncertain. Well, what's uncertain about that? Well, first, you never know if the fish, if you're going to be eaten by a bear today, right? You don't know if you're actually going to make it till tomorrow, especially in a very primitive early economy where there's a lot of risk. The other thing is you could be giving your fish to Bernie Madoff, and he runs off with it. So you never get your capital back, and you're stuck with nothing. You might as well have just consumed the fish, right? So what would cause a person to loan 2 fish to somebody else? Well, the possibility of the gain. So here we're going to say 2 fish can turn into 2 additional fish. So for every 2, you get 4 fish back. I know that would be a pretty high interest rate, 100%, especially since we're not.
We'd like to get those types of returns in our own portfolio.
Yes, we would. And as ridiculous as that sounds, if you go back to the Crusades, interest rates were often in the 30 and 50% range because there just wasn't as much production. Excess resources were actually not nearly as abundant as they are today. But the higher the interest rate, the more likely it is somebody is going to not consume everything, set things aside as excess resources, and then loan them out. So if the interest rate is low, you're less likely to loan them out and more likely to consume. But there's another side of this equation, right? Because if you're going to give 2 fish and get 4 back, then the person that is doing the investment or building that new capital project needs to be able to repay 4 fish for 2. So this is kind of that return on capital, return on investment calculation, or net present value type of calculation, or that interest rate where we're comparing current to future production and trying to understand, does it make sense to do the investment? Because if you could only produce 3 fish out of the 2 fish resources,
why would you do the investment? Why would you loan the money?
Why
would you even borrow the money?
Why would you even borrow the money, right? You probably have some collateral that you're going to lose. So that would be a project that was set aside as not a doable project because of the excess resources and the investment growth potential don't really align. So it would not be a project that would be put into place. So let's take these concepts and let's try to put this into the aggregate economy. So we have our stages of production, we have our consumption versus investment, or really setting resources aside, and we have the loanable funds market. And we are going to assume that for whatever reason, people begin to consume less, so that late stage economy actually starts to drop down, meaning that our consumption versus investment has moved further down towards excess resources being in the economy. Well, what would that have? If there's excess resources, that means the supply of loanable funds has actually increased, and that would shift that curve over, ultimately making the interest rate lower. So try to make it a little bit simpler so that interest rate is now dropped down. That means that maybe it was an opportunity where you had to pay back 4 fish and now it's 3, and maybe that new product now, or that new capital process, makes sense to go ahead and start. So then you would take that excess surplus of resources, and the loanable funds market would move it to the capital investors, and those capital investors, so that here's a shrinking consumption, would then move it to here in that end stage. So in the previous example, we're now trying to build that boat. And what's the point of it? Well, remember, you have to turn 2 fish into 4 fish. So that means the production needs to increase for the economy. So we get higher amount of production through the capital goods and mixing of labor. meaning that our production possibility frontier, or the 7 fish, now appear when we make a trade-off, and there'll be some type of new equilibrium where you're setting so much resources aside and consuming more as well, so the economy has grown. Now, what's the point of all this? Well, we're finally at a place where we have all the tools so that next week we can say, well, what happens when those goldsmiths become bankers and they start to realize they can expand the money supply? What is it going to say in this model when we apply that? Because I think when our listeners see that, they're going to start to understand our theme, why we think the inflation risk at this time is high, why we favor equities over fixed income. It'll take more time and more technical to do the equities and technology. We could do it off of that, but I want to give that a little bit more detail and added. But next week, we're finally going to look at what happens whenever we're in the economic situation that we're in today, where the central banks are expanding the money supply at a rapid pace. So we'll finally have the tools to go through.
So don't miss next week.
Don't
That
miss
sounds
next
like
week.
we're going to finally get into the meat of the matter.
Right. And if you're watching on YouTube, make sure you hit that bell right below to subscribe so you don't miss it. So let's look at the market, John. We are getting close to all-time highs. Hopefully our slides catch up. And we continue to climb that wall of worry. That blue line there has been our trend line. We haven't even come close to reverting back to it. Now, our previous high was 33.86. We're getting very close to that. My guess is we would not just pass it, because a lot of times the market wants to test these valuations before it goes on. So I would expect to see a little bit of reversion back down towards that blue line from here, but it's hard to tell. Looking at the dollar, it has stabilized. I'm going to go ahead and keep talking while our slides catch up for the sake of time. Over the last couple of weeks, it's found some support. Whether it continues down or not, we do not know. I don't think it's a coincidence that the dollar is stabilized and we've seen a drop in gold over the last week. It's had a very, very strong run, but to see the dollar start to stabilize, some of that fear that it is flying into gold will move out, especially those late comers that are starting to see some losses because they were trying to jump into that trend late.
Buy high.
Buy high, sell low. They're out there for sure. So let's look at our relative strength. We have seen gold, which is still near the top, start to slow a little bit last week, and some fear trade move away to other areas. We've also seen that in the technology area. So we talked about Facebook, Amazon, Apple, Microsoft, Google. These have all been big performers. The reason they've been big,
Where a lot of the gains come this year.
it's where a lot of gains is where the earnings actually grew. Most of the S&P 500 is down about 38% on average for earnings, where they were up 2%. Well, as there's starting to look like some positive economic data that the coronavirus is starting to decline and make less of an impact, we're seeing a rotation away from those big, the places that people were hiding out, and we're seeing that rotation. And it's mainly going into mid cap and small cap. So maybe we are going to go on to new highs, and we're going to bust right through it because there's less fear, more certainty about the economy. It's still too early to tell. We're still making rotations. Remember, one of our overweights is mid cap and small cap as we started to reduce our technology. So that actually helped us. Turn it over to you for question and answer.
So, you talk about fear, and there's still a lot of fear out there. In fact,
Absolutely.
people are fearing about what's going to happen as children start going back to school. But it seems like whenever I talk to people who are older, including my 6 older brothers and sisters, so they're older, some of them are immune compromised. They've greatly limited their activity to stay home and barely go out. But even with this fear, we were reading this research report called COVID-19 Opinion Tracker. It was by the KEKST CNC, which is a large international consulting firm. Can you comment on its global findings?
Well, first I'll comment on the risks, especially in the demographics that you were talking about. The coronavirus is more risky, especially depending if you're immune compromised, if you are older. Because if you're a child, and they're still trying to figure this out, but there's a factor that it's ACE2. I don't know what that means, but they have less of it, which means that may be one of the reasons that children really have fared very well. It's rare for them to actually have the virus, but we still see numbers that are higher than, let's say, the flu, so that risk is there. I don't want to downplay that, but a lot of people are very much in tune to the media, and we got to remember the media, what it is. It's a business, right? And they're in the business of selling advertisements. And the way that you sell advertisements is, or you keep the eyeballs click to the tube during the commercials. And to do that, you create an emotional response in the viewers. And it seems that coronavirus has certainly been used by the media to keep people glued and paying attention. So the poll or survey that you're referencing, they asked the question, how many people do you think have died from the coronavirus? And the US, the average response was 9% of the population. That'd
be a huge number.
That is over 30 million people would have died from the virus. Now, there's about 160,000 that has died. On a mild flu, 60,000 people will die in a year. On the stronger or worse flu will be around 140, 150. So this has definitely produced more than the flu, but we're not talking about the magnitudes in order to get 30 million. So I think there's a misperception of the risk that's really coming from the headlines and the way that the news has presented this information. That's not to say the virus isn't real. It's absolutely real. It's not to say that it's not more deadly than the flu. It is, but not to the level that we've really promoted it out in there. My bet is that if we didn't, if the news covered this the way it does the flu, most people wouldn't really know that there was this flu to be concerned about. They would just know that there's a bad flu this year. So I think that media is definitely changing our perception of the risk.
So let's talk about China, because tensions continue to grow there.
Yes.
And President Xi announced a 5-year plan to shift China's reliance on its domestic economy away from foreign investment and exports. So what's your opinion on this plan and the future impact of the market?
Well, we hear often about how China's economy is going to overtake the U.S. It's going to be the largest economy. Remember, they have a lot more people. And to be able to do that, they don't need the standard of living that the American has. So we're still going to have a much higher per capita income than China, even if they were to get over us on the size of their economy. And that's important. And that goes back to that consumption investment possibility frontier. If you are still living in extreme poverty, you don't have any room in your budget for discretionary spending and trying to increase your consumption. The Chinese have done a lot of savings, at least on the upper class, but we're not seeing that in the way that you are seeing it. I know the U.S. doesn't save much either in the lower class, but they just don't have that discretionary income to meet the demand for their economic structure that they have in place. They don't have enough bandwidth in their income brackets to be able to consume at the level that they are dependent upon global markets to consume. With that being said, remember the data that we get out of China isn't the greatest either. So it's probably more likely that the data shows a more rosy scenario than what I'm talking about, but it could be the other way. So I think time will tell. But I think China is not in a great position relative, and not that the U.S. we're cleanest dirty shirt in the closet for sure. But I think the Chinese economy is actually struggling more than the U.S. economy.
So one of the questions that we get from our clients now is, should we take chips off the table? Mm-hmm. In other words, since the global markets have recovered, and what's our thinking right now about taking chips off the table?
Well, we are constantly reviewing the different benefits and the different risks. There's an adage that don't fight the Fed. Or another saying is the Greenspan put that became the Bernanke put that became the Yellen put that you can call it the Powell put. And that is the moment that there's some pullback or sell-off in the market, it's met with an aggressive monetary response or even a fiscal response through stimulus packages. And the Fed can get out and they can jawbone and say that they're going to be accommodative. Actually, they continue to say that they're going to be accommodative because they want inflation. And we think that inflation risk is much greater at the moment than a short-term pullback in the market. Because if we do have a pullback in the market, we think that the Fed and the Congress, as well as the president, will push forward stimulus. So you got a floor on how far it can go down. They could step away, but we find it believable that the Fed would not step away and would provide some value. That being said, as we hit new highs, the investment committee has been discussing, does it make sense to increase cash hubs from 24 months to 36 months? And if we do that, how do we continue to maintain a hedge against inflation if it does show up? So those are the costs and benefits and what we're trying to wrestle with to figure out what's the best way to structure portfolios and try to deal with the fact that we are near all-time highs and there is a lot of uncertainty in the market. And it would be just nice to have 36 months of cash, right? We would be past the next election before we would ever need to tap portfolios if we do that. So we continue to tune in because
and maybe it's something that we're going to consider. As certainly one of the thresholds that we push for overweighting cash in certain circumstances.
Right.
This might be one of them.
I think we're getting closer and closer to the call. Remember, we went from 12 to 24 a couple of years ago. If we continue to see these markets rally, I think it's more likely than not that we will have 36 months of cash and try to figure out how to deal with the inflation with the remaining investments.
So then we have some clients that have cash and they're wondering, should they wait until after the election, especially if we're thinking that the market's high and we might be raising the cash hub target for each client. Should they be putting that cash into the market now?
Well, I think that's a question they need to have and a discussion they need to have with their lead advisors. If you are already fairly well protected if we do see inflation and your standard of living isn't going to change whether you miss another upswing in the market or not, then I think if it gives you comfort that's something that you may consider doing. But if you are still highly dependent upon your investments getting high long-term returns, at some point we think the markets are not going to give great returns. And if we have another 10 or 15% increase in as we go through the election, and then we're going to have very low returns going forward, you don't want to miss out on that. That might be your opportunity. So I think it's all dependent upon what your standard of living is and whether how easy it is for your financial assets to meet that standard of living.
Now, we allocated a portion of the portfolios to the gold miners, as you had mentioned, and now with the dollar starting to rally a little bit, gold has retraced. If the dollar continues to increase, what would our view on gold be at that point?
Well, we are constantly monitoring these, but we'll wait for our technicals to push us out of that gold position. There's been a lot of talk about how growth has continually outperformed value over the last decade. At some point, there's going to be a rotation. We just went through a quick period where tech sold off, energy, finance, staples all rallied, and they're like, it's finally here. And they said that last year, they said that the previous year, and there's been a lot of head fakes. And when we try to get ahead of those rotations, more often than not, we end up being wrong. And it's that our process by waiting with the potential of not catching the bottom and not getting out of the top, we've found it much better to just wait for the technicals to push us out because it has a better feeling and grasp on the market than what way we can try to think up in our mind.
So investors sold off treasuries this week ahead of the new wave of government debt that's coming onto the market. This, of course, pushed the prices higher, which is incredible because interest rates are so low, and treasuries have, because of even the modest downturn from where it was before in terms of interest rates. I mean, treasuries are up 28% for the year. So what are your thoughts on treasuries going forward? And how much higher can the prices go, because interest rates don't have that much room to go down?
Well, they could always go negative. We have seen that. How much negative? That's for academics to argue, and they do argue about that. So could you see another 26-27% increase? Yes, but what we do know is that ultimately you're going to get the interest rate yield on that when you purchased it, if you hold them for long. So we find that the risks in treasuries, knowing that inflation is already over the yield that you're going to get, it's just not worth taking, and we'll miss out on those upswings. And we felt that we didn't have a lot of long-dated treasuries in our bond portfolios going into the year, and we sold off more than the ag because the ag had something that was going the other way. So it's something that we have to be aware of, but we think it's a game of musical chairs. At some point, the music's going to stop, and whatever you caught on the upside is not worth the potential on the downside if interest rates begin to move, or if inflation picks up at a much faster pace and interest rates just stay where they are. The purchasing power loss, we think, is going to be pretty big. So that's why we have avoided it, and we're not trying to play the game of getting out at the top on treasuries. And they could move up again as well, but we're more concerned about that principal preservation and getting that money returned with some interest than we are trying to play the game of eking out and finding the top of the treasuries.
So it looks like we're out of time. So
we can keep going.
We can keep going, but I will probably lose most of our listeners at this point if we keep going.
It'll get really good towards the end then.
Exactly. We have some really good, cool stuff coming on. But I want to remind our listeners that discussions around any specific stock or mutual fund is not an endorsement to buy or sell. It's simply commentary based upon each commentator's opinion. All investments have risks, and past performance is not indicative of future results. However, there's a little bell if you're watching on YouTube. Tell me about that bell.
So, right, if you click down on the corner that has that bell, it's subscribing. Please subscribe. You can set it up where you get alerts, but that way you will know whenever one of these videos is posted on our YouTube video. And most of the presentations that we've done are now available on our YouTube channel.
So how do they share a link with their friends if they want to have people log in for our live broadcast or for the YouTube channel?
So next to the bell, somewhere down there, I don't know it by heart, but there is an arrow that's kind of, you click that and you'll get the link, and you could share that link.
So look for the arrow. That's the arrow and the bell. Those are the two key things. Well, thanks again. And if anybody has any questions, as you know, please call your lead advisor or any member of the team, because we are here for you. So long for now.